General Motors finds itself in a familiar position in the auto industry. With industry-wide production above pre-pandemic levels, the benefit of pricing power is ebbing away. Meanwhile, it faces stiff competition in overseas markets as Chinese automakers are making headway backed by generous government subsidies. That being said, the stock price has done well in 2024, rising from $36 per share to start the year and changing hands at $47 as I'm making this video. Investors have appreciated management's strategy adjustment on electric vehicles. Given the weak consumer demand in this segment, the company has scaled back or pushed back plans to increase supply in this category. I'm going to answer if General Motors stock is a buy right now, looking at its longer-term trends in revenue, cash flow, return on invested capital, debt level, prospects over the next 5 years, and valuation. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. So as I highlighted in the introduction, General Motors stock price has performed well year to date in 2024. You can see that nice uptrend here, though there have been moments of volatility to be sure. Looking out longer term, General Motors revenue has increased nicely, especially since the outbreak of the pandemic. I highlighted in the introduction, the company's had pricing power given the decrease in production that followed the supply chain shortages of the pandemic. The company was able to produce the most profitable models, selling at higher average selling prices, and that was a boom for car companies worldwide. That being said, those benefits are ebbing away now. Supply chain shortages are almost all but gone, and so production levels are soaring again, and you could see inventories at dealerships rising, especially for the non-popular electric vehicles in the United States. Still, General Motors revenue at $178 billion was significantly higher than where it was before the outbreak at $145 billion. General Motors' cash flow from operations to sales is not that great at just 11%. It's been at this level since 2017. So you've seen volatility, ups and downs here, especially as a result of the pandemic, and the rate at 11%. I don't expect this rate to improve much further. The company's cost structure increases when it does well, so it doesn't have all that much economies of scale left to be harnessed, right? When its labor unions realize General Motors' profits are increasing, they come back to the negotiating table and they ask for increasing wages. When their suppliers notice that General Motors' profits are doing well, they negotiate for higher prices. So General Motors is not going to be a type of company that increases its profit margin or cash flow from operations to sales percentages. It's just going to benefit from absolute levels. Well, if you're generating 10% cash flow from operations and you're making $200 billion in sales, that's still $20 billion in cash flow, which is a large number. So that's what the company counts on, just increasing the revenue totals and thereby increasing the totals in cash flow and profit without necessarily increasing the margins. And it's a similar story with its return on invested capital, which is not great, just 5% in the latest update. Let's say 6%, let's round up to 6% in the latest update. The company operates in a very capital-intensive industry. It needs to spend billions of dollars investing in the manufacturing, technology, and research and development, and that's never going to end. It's going to need to continue innovating, continue investing billions of dollars just to stay on pace here in this industry because it's so competitive, because it's so intense. That's why I've not liked the auto industry, and I've been talking about this for years, how I don't like the auto industry because it's so capital intensive, how it's so competitive, and at the same time, the negotiating power with suppliers and with labor unions is not great. And so it's not an industry that's been attractive for me. It's an industry that I've avoided personally. And there aren't very many times or very many car companies I've recommended as buys in the last couple of years because of those factors, because of the structural factors around the industry that makes it difficult for investors to make money. Now, I've always said if you want to make money with an auto industry, in the auto industry, you work for a car company. They offer great wages, great jobs. That's where I think is the best way to make money from the auto industry is by working for one of the car companies, not by investing in one of the car companies. Looking ahead, the analysts on Wall Street that are following General Motors stock, they expect the company will increase its earnings per share by 13% each year for the next 5 years. Now, that comes on the back of a 5-year period where the company earned 31% increases each year. And of course, those were those unique circumstances I highlighted with supply chain shortages, giving the company pricing power and consumers forced to pay those higher prices because there wasn't supply available. But that's not usually what happens in the auto industry. Typically, the auto industry is plagued with way more supply than demand. And that misbalance, that mismatch, creates pricing negotiating power for consumers, not sellers. And so that factor will come back into play over the next 5 and 10-year period as supply is increasing way more than demand is increasing. And unfortunately, since the pandemic, there's been several new auto companies, electric vehicle companies, that have just added millions to the supply side of the equation without taking away previous supply of internal combustion engine vehicles. So the industry's mismatch in supply and demand, I fear, is only getting worse over the next 5 to 10-year period. And still, General Motors, despite that environment, is expected to grow earnings per share at roughly 13% each year for the next 5 years. Now, the stock is not expensive. It's very, very cheap. The auto industry stocks are some of the cheapest stocks you can find. And it's because of the factors I mentioned earlier. It's not an attractive industry, and investors know that. And that's why they don't give these companies high valuations. And General Motors trading at a forward price to earnings ratio of just 4.8, right? And that's even after the valuation has soared from below 3. So the valuation is up by more than 50% in a year, and it's still just 4.8. So it's not very expensive, and that reflects the unattractive nature of the industry, not necessarily this company specifically, but the industry overall is unattractive. Now, I've had General Motors stock as a hold or market perform rating all year long in 2024. I last updated that recommendation on April 23rd. And as of today, looking at the company, revisiting the company's metrics, I would reiterate that recommendation. I don't think the stock is a buy. I would rate it as a hold for now, and I don't expect these dynamics to improve for General Motors going forward. Hey everyone, if you like watching my videos, then I've added a great complimentary product just for you. I've created a book, I've written a book that's available for sale now that highlights my 6-step investing framework. Even if you don't follow that investing framework, just reading it and knowing how I evaluate stocks will make it a lot more interesting and informative to watch my videos. I've added the link in the description below.